All right. Good morning, everybody. So we got the Michigan consumer sentiment that is showing up as potential hot fire today. Um, we can see the impact meter here kind of lit up. We also have additional auctions today. And really it's shaping up to be a pretty laid back day, other than we have OpEx. We've seen a little bit of that OpEx yesterday, with the market running up to pin at one of those spot gamma levels. It was pretty impressive. All right, so Asia had an inside day breakout to the upside. They did pull back later on the session, but still, it's a nice continuation of this base that they're building. And since they close early compared to, say looking at London, and it's only 11:30 over there, this exuberance had started with London to the upside, but as time wore on through the morning, we're back inside. So inside day breakout here. We are holding the lows though. So IX10 at this point, it's not really a wow factor to have an IX10 underneath such a very large candle. But if we get another day sideways and we start having the IX10 underneath these two candles, then it'd be a completely different discussion. We started to see that rebound in WTI and Brent yesterday. So far, it's just maintaining after that rebound, but that graveyard doji, the main takeaway is it's an indecision candle. It's not necessarily a reversal candle. The fact that we're still sitting inside of it says there's still some work to be done on this. I would just, if you're short, I would get some profit out of that thing, right? Get some risk off. And if you're not yet short, you're going to want to see that this is actually going to go somewhere. That's going to continue. Expect all of these lower levels to be defended. There's a lot of money down in that zone. It's odd to see an auction at 10 a.m. That's kind of throwing me off a little bit. But all the other times are matching. So early auction today, I guess, 4-week bill auction, 10 a.m. So we had a really narrow IB. IB is initial balance. It's like a 1 hour open range. So we had a really narrow IB. And then we started now to expand beyond it, like a megaphone pattern. So we are beginning to see a consistent, persistent message, very similar to this message back here. It's not done yet, but something is kicking off, and we're starting to get into a one-time framing situation. Volume is still within our normal boundaries between 1 and 2. This kind of implies that the market is not willing to sit out and hang out on the sidelines for whatever econ is coming, but it's also a part of the OpEx that's going on. Today is expiration day, and we're going to be done with these March contracts. So some of that volume that we saw is from rolling out of that March and into the June. But you can see that's not all of it, right? There's only a small part of it. Everything is waiting on FOMC next week. At this point, it is the biggest game in town. It's what everybody's focused on, because they really want to hear from the Fed about, the ultimate target rate. Where are we going? Are we now in mildly restrictive territory or not? And if we're not, how much farther are they going to have to hike before they consider us in that mildly restrictive territory? It's a mythical thing, right? If they don't know where neutral is, how do they know when they're past neutral into mildly restrictive? It's a unicorn. So what they've been saying is, well, we'll know when we get into mildly restrictive territory, because things will start to slow down a little bit. Jobs and the economic data points will reflect that we're putting a pressure against the economy and slowing things down. Wage inflation will start to come in, and unemployment numbers will start to go up. And they've got these models that they can look at, but they're all backwards looking models. So when something like the bank break last week comes in, then they can look at that and say, well, that's forward data instead of looking backwards. The thing is, all the other banks are managing this liquidity. Only the mismatched, poorly run bank is having a problem. So if the Fed isn't responsible, they're very likely going to continue to raise rates. During the European rate hike yesterday, Christine Lagarde was asked why they raised by 50 points, and they didn't take into account what was going on in the banking system. And she gave a great answer. This was posted yesterday, which is pretty awesome. And it really just kind of crystallized everything nice and neat. So she was asked why central banks raised rates 50 basis points when financial stability concerns are mounting. She referenced the separation principle that lender of last resort functions address financial stability concerns. Okay, so there's that. And then there's rate policy, which is addressing price stability needs. So there's two different concerns. One of these is to address financial stability concerns, while the other one is to address price stability needs. So we should very well expect Powell to make similar statements next week. And that puts us right into the idea of buy the rumor, sell the news, right? He may pause after this next 25, or he may hint or imply that we're really close to being at a spot where we want to pause. But I don't think he's going to not raise rates. So when the market priced in that rate cut, I think they made a mistake. So I didn't post this yesterday. It was posted and then I grabbed it. Ramdo posted it in the chat. I posted it to one of my coaching clients late yesterday afternoon, but I'm not the one that found this. But it does go to the heart of the anticipation, right? And that's really what it comes down to, what we expect the Fed to do. If our expectations are in line with what they just did in Europe, then what the market has been doing by pricing in these rate cuts is they're off, they're wrong. And the worst part is we continued to go sideways and stay weak until yesterday with that big pop up. And that was more OpEx related than anything else. It wasn't because the banking situation is done or we have clearer insight on what the Fed is going to do. So we're still in a situation where we have to get past FOMC to really have a narrative about where this market is going next. If the Fed is done raising rates, we're very likely going to see this market go down, right? If they start cutting, it'll be because things are so bad that they have to cut. And of course, if they're that bad that they have to cut, we're headed into like a crash landing, not a soft landing, not a hard landing, but an economic recession with a massive slowdown. Historically speaking, if you go back and look at when the Fed cut rates, the market went down because they're not going to cut unless things get bad. So I'm not expecting a rate cut. I'm not even expecting a pause yet. And I think once the market figures that out, we're going to see a little bit of volatility, but I don't see, 3,600 and 3,500 on the table. I just don't see that. We don't have any reason to believe it's going to be that bad yet. So, maybe 37.5 on the low end of that scale. And, we still have this August high from last year for the high end of this. So 4,300, 4311, the cog line. They said that 2023 was going to be the sideways year. And it's very likely that this is going to be the zone that we stay sideways within. That's a really big zone. So that doesn't help much, right? They need to, we all would need to tighten that up a little bit. For today's trading, the first goal for me is to see price get out of this range or zone. I'm not really interested in trading within the Globex range. So if we can get out of that range, might be a little more interested. As for an inside day breakout, it's possible that we break out of the downside, but that's like the least likely scenario. It's more likely that we just chop inside of this range. And if you go over and read, spot gamma and say tier 1 alpha, then pinning at around 35, 39, 35, pinning there on the week wouldn't necessarily be that far off. I've heard 39.20. I kind of like 39.33 myself, but I wouldn't expect this market to expand another day to the upside. That big move had a lot to do with gamma dealer hedging and pinning levels. So we're there. It's not like they were unloading something. They were driving it to something, and they reached their destination. So I wouldn't expect another big run, and I don't really expect a massive sell-off, mainly from the idea that that would unwind everything that they just did yesterday. 39.50 certainly on the table. It's one of those points from spot gamma and seeking alpha. Not seeking alpha, tier 1 alpha. Too many alphas. All right, volatility trigger at 39.80 for the ES. 39.31 is one of the combo triggers. 0 gamma 40.87. We're not likely to get past that 4,000 level, which is a large gamma. And I don't see us getting down into the cog line at 38.30 either. Right, so more than likely 39.50. And if we, think about OpEx and the fact that it's probably going to be more SPX than ES, 39.50 the volatility trigger, and 39.50 the large gamma level. So 39.75, 39.50, 3,900. My bet, 39.31, 39.32, right around in there, 39.33. Oh, that's for the 16th. Never mind. I was going to bring over the founder's notes, but they're still yesterday's. Gotta wait. All right, 10-day, 30-minute volume profile, TPO and volume profile both have the point of control right where we're at, 39.90, very close to that 4,000 level. If we break to the downside, say below 39.75, we're in a new air pocket, or we're back into that air pocket, and we're very likely to move through it very quickly, just like we did yesterday. That clean, sharp, aggressive move to the upside with almost nothing slowing us down. That's because there really wasn't anything here to slow us down. It's a big, wide open air pocket. And yeah, air pockets exist to the upside just as much as they do to the downside. So we moved through that zone really fast, and we really didn't leave many footprints behind. If we break back down this morning, we could just as easily fall right through that zone again. And we've spent a considerable amount of time there. We can see that in this blue profile here. right? So it's not like we just ripped right through there in a single candle, like some kind of econ event. We worked our way through there, spent time along those levels. To the upside, if we could get through 40.21, then we get a nice air pocket up to 40.50. But there really isn't a whole lot of expectation that we're going to get into the 40.50 zone. Mapping out the 5x5, we hit this point of control at 4,005. It's been there, oh, I don't know, about a week. But we hit it and it did its job. So a lot of times I mention that these are not support and resistance levels. They're just areas where we anticipate there might be a reaction in price, right? And the way that I usually phrase it is, if we're going to reverse, this would be a really great spot to reverse at, because I don't know it's going to reverse there more than anybody else knows. But it does become a reversal zone. So it's a spot where I anticipate a reaction. We don't need it anymore. We take it off the table. I guess I should have kept it and just moved it down here. That is a VPOC 3893. It didn't get hit in this little drop, which still leaves it on the table. So as bad as everything felt earlier in the week with these sell-offs and these moves to the downside, our weekly expected move way down here at 37.80, and it was never touched. In fact, we only spent a small amount of time below Friday's low on Monday and on Thursday. So while it felt really crazy out there this week, the upside move actually put us outside of the expected move to the upside. Now 39.80 on the ES, 39.78, right around in there, is the line in the sand. And we already have next week's starting to be plotted. And right now it's looking significantly smaller than the current week. So they shaved some time off of it. Feels like I'm missing it. Is there a holiday next week that there's only 4 days? Easy way to find out, I guess. One, two, 3, 4, 5. Nope, it's a 5-day week next week. I had to check because that's a much smaller box next week. So they've certainly taken a lot of volatility off the table for some reason. Exactly right. Eve, and that is kind of my point of looking for, thinking maybe it was a short week or something. Because with FOMC, you would absolutely anticipate that there's going to be more volatility on deck, and that the expected move for the week would be bigger, not smaller. So that just really doesn't make much sense to me. On the other side of all of this, though, the 10-week moving average, we're very close to it right now. We're less than a quarter of a percent. Which means we're not overbought, we're not oversold. We're in the center of the basketball court, and we could make a big move up or down either one, and it wouldn't be out of line. It wouldn't be, moving too far, too fast. Now we are above the 10-day by 0.5%, and that's not by very much. If you look at how often and how far we get above the 10, to where sometimes, we're 3.5% away from the 10-period moving average. Right now, we're 0.5% away from it. That's a negligible amount, just a fraction, really. So we're not in the center of the court, but we're pretty close to it. And again, all this indicates is we could make a big move up or down, and it wouldn't put us into overbought or oversold territory yet. I got this phrase that I use a lot: don't diddle in the middle. Well, it kind of puts us right where we are right now. If you're looking for a bigger play, like maybe a longer term swing sort of thing, one, why would you want to start getting into some swings right before FOMC? But that's just me. And two, you really need this to get out of the box, because if the S&P is range bound like this, generally most of the time, most of your other stocks are going to be like this, right? They're going to reflect the S&P more often than not. So if this is range bound with nowhere to go but into resistance or into support, so's a lot of the names that you would want to trade. So this needs to get out of the box, and we're not necessarily in a good position to get in because we're in the middle of this zone or range. And from here, we have every right to go to the top or the bottom, and we still wouldn't know which direction the trend is going. So we really need to get out of this zone, this box, this range. It's a really nice Busby, by the way. I pointed that out yesterday afternoon in my trade review video. All that it owed us back up to the top. So for today, keep your eye on econ with the expectation that we're going to have a choppy, violent day, likely with a lot of volume coming in because it's going to be the last day to get that rolling done. And the expectation is that we stay inside of yesterday's range, but that's such a very big range that it's not helpful to say that. We do have an MDP right now, by the way. It's a missed daily pivot. It's a strategy that I don't necessarily trade, but that I think has a lot of insight when you're looking at the markets every day. And we are above the weekly pivot point, which puts us into a bullish posture. We got three names down here on the bottom that generally come in when we see like that short covering rally that we had yesterday. Bitcoin, ETF, BITO. Bitcoin represented as GBTC, and then KWEB, which is the China Internet Index, but we basically just look at it like the China ADR representation. And of course, you got like emerging markets way, way farther away than these three. But these three, mainly, there are two groups, the Bitcoin one and then the KWEB one. That's very, very bullish. So this is getting a lot of liquidity this morning, and they're up significantly from their close. This is up nearly to $15 this morning. So kind of like a blow off top here in energy. This is a great representation of the Bitcoin proxies, right? So we go over to like TrendSpider. We look at my crypto list. Riot, Mara, BTBT, BITO, Coin, MSTR, SI, SOS, AMD, Square, TSM, PayPal, NVIDIA. Now, granted, those chip names are pretty far down the list when it comes to what's up this morning in the pre-market, but they're still on that list. So you can see its diversity reaches into a lot of places, right? But the main ones this morning are like Riot, over 10.75%, and Mara nearly 10.5 this morning. Coin more than 6%, MSTR 5.75. I mean, these are big moves, but they're all a representation of those two ETFs that I mentioned. So they're great proxies, right? Rather than having to look through that entire list that I just showed you, you can just look for these two names. And when these two names are up, then you can follow it over and see what name in these baskets are up. So why do we care, right? Like, so what? They're up. Okay. Captain Obvious. What do we get out of that? So it's going to feed the fire for risk on sentiment, risk on behavior, and risk on appetite, that the bullish continuation from yesterday could continue in, not necessarily in the indexes, because the indexes are going to be controlled by the dealer gamma hedging situation, but in the rest of the markets, especially say in those Bitcoin proxies, but also into tech. But they're not just window dressings either, because if we start to lose those names to the downside, it'll very likely take everything else with it. So they're not big enough to move the market. They're just a part of the sentiment that's going on with the market, and they stand out and they're easy to spot. When you see those two, BITO and GBTC, you see these two moving, then you know that people are feeling bullish, risky, and they're putting their money on the line. And then tie it in with the KWEB constituents, and you start to get a significant move across the markets. PDD, nice run up this morning. JD, a bit of a dud perhaps there on JD. Baba, it's giving it back quite a bit, but I'd say BABA fits that. BABA and Baidu. Baidu is still holding on to most of that overnight pop. BABA's giving a lot of it back already. I think if we start to lose these two, it might take a lot of that NY Fang with it, because remember, those are in the NY Fang list. I was kind of hoping to see that they had replaced Twitter with something, but I haven't seen anything yet. All right, so we still got weakness in XLF, the financials. But they're stable, right? They're not crashing and burning. And the 10-year pulled back again towards that 3.5. 3.3 is still the line in the sand, right? As long as it's holding above that, we're not in a critical situation. We were getting really close to a critical situation when this was getting up into that 4% area. And when we were dropping down into that 3%, 3.3 area. So we're really trapped in between this, oh my goodness, area on each side. Either one of those, above 4 or below 3.3. And start getting into a lot more drastic situations. This is down this morning, but it's not crashing and burning. Not like some moves that we saw the other day. All right, we don't really want to see a repeat of that. And we can see the front end of the curve, like the 5-year, kind of up a little bit. It's still maintaining inside of yesterday's range. And what we would want to do is use this big candle from back here. Just kind of mark that. If we were going to keep this bullish move, we should not have fallen below 50%. Now that we have, that support that didn't hold is now resistance for a move back up. And it's kind of where we're getting tangled up this morning. It's that 50%. So bonds are up, yields are down. Dollar's down, inside day breakout. It tried to recover and come back in, but couldn't keep it, and it's back down again. Notice how sideways it was yesterday. And think about the move that we saw in the S&P, but we didn't see any real activity here to help us out. That goes back to the indication that yesterday was more of dealer gamma hedging and options flow, and less about what was going on with bonds and yields and the dollar and the rates and the global situation. Right? This kind of validates or confirms that. So we could see some contagion come out of Europe, but the fact that we managed to make it through the day so far without them really crashing and burning. London's still inside day. They're down, but they're not breaking to new lows. Means we're probably fine with that rate hike and the market contagion through the banks. So far, their banks didn't implode. We're probably good through the weekend. But the next thing that's in line is US dollar Japan. So a whole lot going on over there. And next week, we have a lot of threat coming from that direction. Plus, we have the FOMC. So there's really a whole lot going on in the next week that gives us a lot of risk on each side of the market. It's not like we have long tail risk or short tail risk. We just straight up have risk on each side. From the European bank implosion and contagion that would spread around the world, to Japan with their new Bank of Japan leadership. He's new. He could very easily put his foot in his mouth, say something that, whips markets around the world. Our own FOMC, there's a whole lot going on in the next 10 days that should have next week's expected move range way bigger than it is right now. I think the market makers got that wrong, way wrong. So I'm going to stick to the argument from yesterday. If you were to buy some 4,200 calls really cheap and or some 3,600 puts, maybe in a spread because they're not so cheap, you could very easily see both sides get hit in the next 10 to 12 days. Now, it doesn't owe us a big move. So, don't run out putting on a bunch of money on one side or the other thinking, well, it's going to go one way or the other. It really doesn't have to go anywhere. It could just be a dud where everybody anticipates a big move, hedges for it, and then we don't get a move at all. But there really is a situation right now where there's a large risk globally with these three events. So just kind of look at what you're holding and ask yourself, could it sustain, an 8% move in the S&P up or down? You can bait away your portfolio so that whatever you are holding, Apple, Amazon, Tesla, whatever, it doesn't matter what you're holding, you can turn all of that beta into SPY betas and then look at how far SPY would move and see how that would affect your account. Beta weigh your portfolio and really understand your risk. Otherwise, on the other side of all of this, as we get through with March, the last week of, we should have a really clear mandate from the Fed about where they're going from here. And I honestly believe we're going to finally come out of this zone that we've been in for the last couple of weeks in this holding pattern here, where we were here and then we legged it down, right? That's been our holding pattern. And then we legged it down and now we're back up into it. But it's coming to an end. I really believe that we're near the point where we're going to come out of this one way or the other. Hopefully, cross your fingers. So if you're looking for some bigger opportunities, some longer term swings, let's get through this and you should be set up for that with a clear narrative that we're going to continue to the upside or to the downside and be able to, really play it through. All right. So that's what I got for you guys. Be careful, be safe, watch the clock today. Just remember that it's OpEx. And while we anticipate that we're going to see a lot of volume, we're not necessarily anticipating an expansion beyond yesterday's move. And that if we do begin to expand beyond that, just look at those spot gamma levels. They're round numbers and they're quarters. 39.50, 39.75, 4,000, 40.25, 30.25, 3,900. And you can see that when you go in and look at the SPX in the options chain, right? You can see that liquidity in the open interest on those levels, right? Look at that, 39.50, 57,000 open interest. And on the other side, 54,000, nearly 55. And as we come into the day today, right, into the 17th, this 0 day, because really those are done. You want to watch these levels and watch for the volume to really start picking up on these particular spots. All right, everybody, I'll see you next week.